Hello everyone and welcome back. In this video, we're going to be going over some of the differences between option ETFs and dividend ETFs and which one may be a better choice for you. So in my income portfolio, I do own two different types of ETFs. One is a conventional dividend ETF called SCHD. It is a very popular dividend ETF among dividend investors. And the other one is more of a option ETF that uses an exchange-linked notes option strategy to provide investors with income. So I'm going to be going over the differences between ETFs like SCHD and ETFs like JEPI. And before we begin, if you do enjoy content like this, definitely subscribe for future content. And if you do appreciate the video, leave the video a like. So when it comes to dividend ETFs like SCHD, there's typically an underlying investment methodology that they use to select the holdings. So in the case of SCHD, it has an investment methodology of selecting high dividend yielding stocks issued by US companies that have a record of consistently paying dividends, and then it further selects them based on financial ratios. So through that criteria, you basically get a list of stocks. And then this is the list of the top 10 holdings in SCHD from that selection methodology. So with these holdings, you're going to be getting income from these stocks. So these stocks pay dividends, whether it be Broadcom or Home Depot, and even Verizon, which pays a pretty high dividend. Same thing with Chevron. So with a dividend ETF, you are receiving income from these dividend paying companies. Now, in the case of SCHD, you're getting a current yield of about 3.44% for those dividend paying stocks in that ETF. So if you invest $10,000 yearly, you're going to get about $344 roughly. That will change based on market conditions and whether or not they increase their dividends or not. So generally speaking, depending on the ETF and its selection methodology, you are going to get an increasing dividend over time. So your yield on cost is going to increase. Every year, these stocks are going to grow their dividend, whether that be 5, 6, 7%, and you are going to get that increase over time as the dividend investor. So I'm just going back on this dividend history here, and as you can see, the overall dividend payment increases over time. So now we're down in 2014, and if we scroll back up, you see how that dividend increased over time, again in that cash amount column. So I'm going to use the covered call ETF QYLD. It is a very popular choice among a very high yield income investors. This is what is known as a covered call ETF, as the name suggests. And the way this ETF operates is that it sells covered calls on the NASDAQ 100. There's another popular ETF called QQQ, which is an ETF that invests in the NASDAQ 100. So if we look at this strategy here, QYLD writes call options on the NASDAQ 100 index, saving investors the time and potential expense of doing so individually. Now, unlike the conventional dividend ETFs, the underlying holdings of a covered call ETF don't necessarily need to pay dividends because they're not investing in dividend stocks. They're investing in various stocks based on whatever selection criteria it selects. In this case, it is the NASDAQ 100, and then it sells covered calls. So if you look at a lot of these stocks, some of them do pay dividends like Microsoft and Apple, and others not so much like Nvidia and Amazon. So these stocks here don't pay any dividends whatsoever, but because they are selling covered calls on this index, the investors are going to still get significant income. So to understand how an ETF like a covered call ETF works, you need to understand what a covered call is. And basically what a covered call is when you sell a covered call, you give the buyer of that option the right to buy your shares at a specific price point. So in this case, I am just going to use a price point of $100, also known as a strike price. And if the price of an asset goes above $100, the buyer of that option can execute and they will take these shares from you. So this can work in the case of a buyer because if you are the buyer and the price of that asset goes to $110 a share, but you are obligated as the seller to sell it at $100 a share. The buyer will buy it from you at $100 per share, but now they own something that is worth $110 a share. So what you're going to get though in exchange for that option to buy that you are giving that buyer is something called a premium. So generally there's going to be a premium that you get. From that contract that will possibly be a kind of insurance that you are getting. So let's say you own QQQ, and this premium is going to be the income that you are receiving. So perhaps better put is the fund page for QYLD. So QYLD engages in options trading. An options contract is sold by one party to another that gives the buyer the right but not the obligation to buy a call or sell a put stock at an agreed upon price within a certain period or a specific date. A covered call option involves holding a long position in a particular asset, in this case US common equities, and then writing a call option on that same asset with the goal of realizing additional income from the options premium. QYLD, as explained before, writes covered call options on the NASDAQ 100. And by selling a covered call, the fund limits the opportunity to profit from an increase in price of the underlying index above the exercise price. So using that covered call options selling strategy, you do generally get a much higher yield than a conventional dividend strategy. So in this case, QYLD is currently paying a dividend of 12%. So if you are putting $10,000 in, you're getting about $1,200 compared to SCHD was about $350 or so. So you're going to get a lot more income relative to your capital. The thing about these covered call ETFs is since they don't own underlying stocks that generally raise their dividends, or in other words, they're not directly investing in dividend stocks that have the intent of increasing their dividend over time, they're getting this income from covered calls, which generally does not increase over time. So if you notice in this cash amount column, this monthly income generally doesn't increase too much, and in some cases it decreases quite substantially. So you are not going to get an increase in dividend payouts over time because you are not investing in stocks that are increasing their dividends. You are using these covered calls to get your income instead. So this is one of the major differences. So if we go back real quick before I get into this, you do see that the income you receive does change over time. Now, the reason of that is because options have their own pricing methodology. So one of the ways options are priced is through something called the Greeks, and there are various different Greeks, whether that be what I'm going to get into, which is something known as Vega or Theta. Vega is a measure of volatility. So when volatility increases, the price of that contract, that option contract, is also going to increase. So when you are selling options, you are going to get a bigger price for selling when volatility in the market is high. So that is kind of why that price on that QYLD yield does change over time, because during some of these months, volatility in the market likely increased substantially. So as the option seller, you are going to get a much larger premium. So while the income you receive from covered call ETFs like QYLD will be greatly impacted by various market conditions, the dividends you receive from an ETF like SCHD will generally be impacted by the performance of the stocks themselves. So that's kind of like a key contrast. I think a lot of investors for income, they kind of mix up the two. And even in fact, sometimes I say when I get paid from an option ETF, I'm getting a dividend. I'm really not. I'm just getting a form of income that is from that option sale. So it's two distinct things. A dividend ETF, again, is based on the underlying stocks it holds, while an options ETF is based on that specific thing, which is an option and volatility in the market. So why is that distinction important? So with an option ETF, now this is a generalization because some option ETFs, the way that they are structured, they're kind of designed to go up depending on the strategy. But now typically with an option ETF that is a covered call ETF, the growth, as mentioned before, is going to be hampered because, again, you are given the buyer of the option that you're selling the right to buy the shares at a specific price. So if the price increases, they're going to buy away those shares, so they get the benefit of owning $110 stock at $100. So you're basically capping your gains, and as we see over time with QYLD, the fund decreases over time because those capital gains are hampered. Now, again, you are paying for that with major income upfront. Now, in contrast, a dividend ETF like SCHD is designed to increase over time. Some of these dividend ETFs don't do that well at increasing over time, but in an ETF like SCHD's case and even like VYM, these ETFs do increase over time and they also pay a dividend. Again, they don't sell those covered calls, so they're getting their income from dividends in these companies, and the companies themselves generally and hopefully will increase over time in capital appreciation. Okay, so what is the conclusion? Like, are option ETFs better than dividend ETFs? That completely depends on what type of investor you are. So if you need huge current income today, an option ETF might be your best bet, but you're going to have to understand your capital appreciation is going to be completely hampered. I see a lot of older investors that don't have a ton of capital, like $200,000 or so, buy something like QYLD, because if they buy an ETF like SCHD, they're never going to be able to supplement their income because that 3.5% yield is just simply not enough. But that 12% yield that QYLD provides does give them a good amount of income. Now, if you are a younger investor, on the other hand, an ETF like SCHD may be good for you because you get the benefit of that capital appreciation with that dividend growth that we mentioned before, and that yield on cost is going to increase over time. And that is going to be it for the video. Remember, if you did enjoy this content, please give this video a like and subscribe for future content.